A very good afternoon, good morning. Welcome to HYCM's live market analysis with myself, Giles Coghlan, Chief Market Analyst. Do hope everybody is doing well. Look forward to taking us through this session and looking forward to getting us ready for this week. It's quite a week, very significant. Could potentially see some big moves this week, so definitely worth being in touch. Main event, of course, is the Federal Reserve meeting on Wednesday. There's also some other significant events. Got the ECB meeting and some important inflation data out for the US, as well as some important inflationary data out for the UK, not in terms of the headline inflation, but in terms of jobs. So, plenty for us to be looking at this week. The different entries and exits, we're talking about the whole idea of this workshop webinar is that we're looking at it from an educational perspective. The idea is you look over my shoulder and you see what decisions that I'm making. It's not a signal trading service as such at all. We'll be looking at a few of the big things. The last interest rate decision for the Bank of Canada, the ECB interest rate decision, Fed interest rate decision. We will be getting ready for that completely on Wednesday. So do come to the workshop on Wednesday. We'll have a special focus just on the Federal Reserve interest rate decision, and we'll be looking at the latest pricing there and then on the Wednesday. That will be important because we have big headline inflation data, CPI data coming out for the Fed on Tuesday. So seeing how the market reacts to that will be crucial for Wednesday. Aussie Jobs data on Thursday. That will be important in terms of the RBA's latest move. Both the RBA and the Bank of Canada hiked interest rates unexpectedly last week. We'll unpack that. Japanese yen, just run over that, as well as looking at gold and oil. So there's plenty for us to be getting involved with. The way I'm going to do this webinar is, first and foremost, we're just going to go through the calendar for this week. It's a very important week. So let's go through the big events as well as the big opportunities that are potentially there. So Monday, gentle start to the day. There isn't anything particularly noteworthy in terms of economic data points. So markets have started, if we just take a look around markets, sort of more positive with risk. You can see here the risk tone has started positive. Dow, S&P 500, NASDAQ, all on higher futures markets before the US Open. We got the DAX and the Euro stocks higher, FTSE 100 higher, China 50 flying a bit of a base there. Now, there's a couple of longer term things I just want to briefly mention to us. This is worth looking at. China's 50, from a long-term perspective, this could potentially be offering decent value. Look, just notice this peak to trough that we've got here. The peak to trough that we've had is about 46%. And notice this near-term trend line, how we've seen it broken, tested, and holding. So a very sort of low risk, high reward entry as a market with stops underneath that 11,000 region. So the potential for the China 50 to reverse here is quite a decent, potentially medium, longer term trade. The risk, of course, with it is that China's recovery from post-COVID lockdowns has been disappointing markets. That's why we've been seeing this selling recently. If we just go down to the daily chart, we've been seeing selling. Market just wasn't recovering as quickly as investors were hoping after COVID, but still we are holding this trend line. So a high reward, low risk area would be long market with stops underneath this swing point, and then if we go back below that trend line, you can consider exiting the longs and waiting for another better opportunity. But that's worth looking at for China's 50, medium term opportunity. There are risks if the slowdown carries on and China's sort of pivot towards common prosperity and the global economy slows down and the Fed is more aggressive, and this could easily see another leg lower and we could take out those lows. So there is risk there. And a similar commodity that's worth looking at is copper. I was speaking to some Reuters journalists about copper prices on so the middle of last week. Actually, it was the Bloomberg Ashraf I was speaking to them, and I was talking about the potential. It was at Citi forecasted copper prices to basically double in price, and they were seeing upside for copper in the next sort of 6 to 12 months, and that's definitely very attractive because there's a big demand for copper that's expected to hit the globe due to the pivot towards green energy and electric vehicles. And if you just look at the HYCM blog, I've written extensively on this demand issue, particularly here with the supply issue for copper. That was something that was lifting prices around the start of the year, but that's not really the one I want to look at. It's this longer term gains piece. The industrial demand is set to increase for copper, and there's one post I want to show you. Where is it? Yeah, there it is. What's the energy transition? This is worth looking at, how the energy transition for green energy is set to boost the demand for copper. You can see all these different green energy technologies that will be using copper, and there's this decent, I'm trying to find the demand that's expected to really, where is it? It could be here. Let me just find, I'm struggling to find it. The piece I'm looking for, here it is, here it is. This is the piece I was looking for. Sorry for that. If you look here, you see every single demand according to ING scenario has copper prices, has copper demand increasing significantly. Whether it's wait and see, whether it's likely tech, fast forward, if you look at this perspective, copper demand is expected to rapidly increase over the next sort of 10, 15 years. And similarly, it's expected to increase like that for wind, solar, and the main winners is copper, aluminium, nickel, lithium, cobalt in these green energy pivots. So that means copper prices from a longer term perspective are looking quite cheap. We have seen sort of significant downside in copper since the start of the year. And the longer term perspective expected copper to find buyers. Just be aware of that. We can easily see another dip lower in copper. So I'm not saying buy copper now, but just want to bear in mind that a lot of analysts are seeing copper prices doubling in the not too distant future, sort of 6 to 12 months out. Citi are seeing copper moving significantly higher. So watch out for copper prices as we move forward. Commodities are pretty much sort of flat on the day. Oil, WTI, Brent crude are both lower. Gold, copper, silver, mixed picture. We'll have a look what the dollar's doing. Bonds, finding some bids into bonds, yields dropping lower. That's obviously supporting gold prices. Dollar slightly lower on the day, moving back up towards its pivot point. And we can see the broad outlook for the majors pretty much flat at the moment, which kind of makes sense given the fact that we haven't got any major drivers going in the markets at the moment. So Tuesday, this is where it gets interesting. Okay, so first of all, we have this UK employment data. Now, what I'm going to look at here is, remember this curve called the Phillips curve. Now, what this is most central banks adhere to this Phillips curve. And what it means is when employment is strong, in other words, when there's only a few people unemployed, so strong employment equals high inflation. Weak employment equals low inflation. So the thinking is when people are in work, they have the capacity to demand higher wages, and that's inflationary. They also have the wages to spend in the economy, it's inflationary. When people are out of work, they are less able to demand higher wages, and there's less people in work, and it's deflationary. So understanding that's key. And now we see UK labour data. So first of all, average earnings and unemployment rate. So if the unemployment rate comes in really low tomorrow, so that comes in below 3.8% or below, and say the average earnings comes in 7.1% excluding bonus or higher, 6.2% and higher for the including bonus, and the employment change, say that goes above 225,000. So we want to see employment above 225, unemployment 3.8 or lower, average earnings including bonus 6.2 or higher, 7.1 or higher, then we expect the pound to gain. A lot of concern has been over the core inflation print for the UK. And if I just show you how high that core inflation print is for the UK, you can see, and you'll get a sense of that right now. So if you look at looking at the G20, right, UK's got very high inflation, 8.7, only behind Turkey and Argentina. And look at the core for the UK, it's 6.8. And you see the way that surged? That surge in core inflation is what's really worrying UK mortgage providers. And you saw this message on the news feed come out today. Where is it? Yeah, HSBC, big UK bank, warns that mortgage costs have further to rise. They're trying to limit the pain. Okay, that comes after HSBC pulled all of its residential, buy-to-let and business mortgage deals, which were available via brokers, following a large increase in demand, right? So people are scrabbling here in the UK to try to lock in mortgage deals because interest rate expectations are just surging. You can see here after the strong inflationary prints we've had, look at the way it's been rising higher. You know, markets are expecting 81% chance now of the Bank of England hiking interest rates on the 22nd of June. So what that means is that if this comes in higher than the market's expecting on Tuesday for the employment data, we'd expect to see significant upside in the pound. But the best opportunity will come from a miss. So say the employment change comes in below 142, unemployment comes in above 4, say 4.1, average earnings below 5.5, average earnings below 6.3, then we expect the pound to unwind some of its recent strength. So a good potential pair to be looking at would be the pound Aussie dollar short or the pound CAD short. Now, the reason we like the pound CAD and the pound Aussie short is both the Bank of Canada and the Bank of Australia hiked interest rates more than expected last week. Bank of Canada, you can see here that there's this big tick up in interest rate expectations, 50%, 73% chance they're going to hike again in July. And the markets have gone from expecting a terminal rate for the Bank of Canada to actually expecting the Bank of Canada to hike again, right? And the Bank of Canada are now completely data dependent. So if we've got a big miss in that UK data, pound CAD downside or pound Aussie dollar downside makes sense at this stage. So look out for that. The best opportunity for the core inflation print would come from gold. Now, what we'd expect to see here with gold is, hang on, I've just had a message come in. So I just had a message come in, but now, if we see here the inflation print come in very low, that's the best opportunity. So US inflation, the headline is much better, 4.1, expected to fall from 4.9, and the core expected to fall from 5.5 to 5.3. So if you look at US inflation, you can see that, look, that core expected to fall again from 4.9 now to 4.1. So that's good. And the core is expected to fall again from 5.5 down to 5.3. Good. So best opportunity comes headline 4% or lower, core inflation 5.1% or lower. Month on month 0.2% or lower, core inflation rate 0.4% or lower. In that case, you'd expect gold upside, right? Now, gold is being pushed and pulled around by the dollar and yields. So if we see a big miss in inflation, headline below 4, core below 5.1, month on month below 0.2, you'd expect gold upside. That's the best opportunity. If it comes in very strong, 4.3 for the headline, 5.4 plus for the core, 0.4% for the month on month, then that should support the dollar. That should also support yields higher. And with the inverse correlation between yields and the yen, you would expect the dollar yen to rise if it's a big beat. Okay, so a big beat in the data, you expect dollar yen upside. Big miss in the data, I expect gold upside. Wednesday, the main event is the Fed's decision. Now, what happens on Tuesday will influence what the Fed do on Wednesday. So at the moment, you can see markets are expecting terminal rate of just 5.25, right? And then no cuts this year, really, at the moment. 75% chance of no change on Wednesday at the moment. That'll likely change depending on the inflation data, so just be aware of that. Whatever happens on Tuesday will impact what's expected for Wednesday. Now, we will have a full rundown on this on Wednesday. So don't worry about that data point right now, but instead, what I want you to focus on is the big picture. And the big picture is that if we see inflation missing, then that will be expectations will rise that the Fed will be able to pause hiking rates in June. That should weaken the dollar, that should send yields lower, that should support gold and should support equity markets. That's the basic rule of thumb. Now, if inflation is very high, that should strengthen the dollar, push yields higher, push dollar yen higher. That's negative for gold, and that's negative for equity markets. So that's the basic rule of thumb that we're looking at, and that's what we should be looking at. Just got a question here from Fahad. Do we have to register for each session individually? We only register once for the whole series. Fahad, please check with support, but I think you register once for the whole series. That should be enough. And please do check with support, Fahad, because I focus on the analysis and not on the administration. So please excuse me if I'm not 100% up to speed with how it works. New Zealand GDP growth rate, that'll be quite important. At the moment, markets are kind of thinking that the RBNZ won't need to hike interest rates any further. But if that's really strong, then you'd expect the Aussie New Zealand dollar pair to fall. So watch out for that. We've seen like some really decent gains in the Aussie New Zealand dollar pair. If you look here, what you'll see is the Aussie New Zealand dollar has been moving higher because the RBA are looking at hiking interest rates more aggressively, and the RBNZ are potentially looking at holding. But you see a big input GDP print for the New Zealand dollar. You expect this to fall lower, but I'm expecting buyers on the dips. So watch out for dip buyers in the Aussie New Zealand dollar pair for sure. Okay. That's if we get strong data. Now, this is interesting here for the Australian data. The RBA, if you look at what they did, their last interest rate decision, they hiked by 25 basis points. And you can see that currently terminal rate expected just under 4.5% at the end of this year. So in other words, markets are seeing like a 33% chance they're going to hike by 25 basis points for the next meeting in July. So if the labour market is very strong, and remember the RBA said in their last rate meeting about the strong labour market, if we just go to the RBA, you'll see here, if you look at the RBA rate statement, June, that came in last week. You see they talked about the tight labour market. Wages growth has picked up in response to the tight labour market, high inflation. So tight labour market means that unemployment rate increased, employment growth is moderated, firms report that labour shortages have eased, though job vacancies and advertisements are still at very high levels. Okay, so they're saying that conditions in the labour market have eased, but they're still at very tight conditions. So remember this Phillips curve, it's inflationary. So if there's a lot of people in work, right? If the unemployment rate is low, that's inflationary. If there's more people out of work, that is deflationary. So what that means for our next decision for the Aussie employment data is, say this comes in very low, it's a big miss. So the unemployment rate is 3.8% or higher. Say the full-time employment is a big miss, that the participation rate falls and the employment change is 5,000 or lower, or even negative, even better if it's below -4.3, below the prior reading. That would show that the labour market is starting to soften, and you'd like to see the Australian dollar weaken. So you could potentially see Aussie CAD downside on that, or Aussie New Zealand dollar downside. So that's what I'll be looking for. If it's very strong labour market, then that would support Aussie New Zealand dollar upside. Remember to weigh that against what the New Zealand GDP growth rate was. So if this was a big miss for New Zealand the night before, and then this was a big beat, Aussie New Zealand dollar upside would make sense. Got some more Chinese data. Do keep an eye on that in terms of what's happening with Chinese growth. And then we've got the ECB decision on Thursday.
Since it was posted
now,
about 50 minutes.
This is important, what's happening with the ECB. Expectations are that 15th of June, that they're going to hike almost 100% seen for 25 basis points. And then they're seen hiking up to just under 3.69% by the end of the year. So they're expected to potentially have 2 more interest rate hikes this year. So what will be very important for the ECB is what the forward guidance is. If they hike by 25 basis points or 50 basis points, you'd expect euro upside, and I'd look to trade it against a potential weak currency. So look for whichever currency is weaker on the day. You could use a currency strength meter. I would probably just use this and have a look what's the weakest currency on the day when we get to Thursday. But for now, you could expect, if the forward guidance indicates that the ECB needs to be more aggressive in hiking interest rates beyond what stir markets are saying, that expect euro upside. If they sort of say, okay, we've done 1 interest rate hike, we don't want to, that's it, we're done, then look for significant euro downside. And the go-to pair would be euro US dollar, would be a go-to pair, particularly if the Fed look like it being more aggressive. But come back on Wednesday and I'll get totally ready for the Fed there. Friday, got some more Fed speakers, Bullard, Waller, and we've got the consumer inflation expectations. Now this is important. It's the preliminary reading, so it's the first of 2 readings you get. It's likely to be the most market moving, and this gives us a good indication of how the US consumer's feeling. If we start to see a big drop here in consumer sentiment, then that could be significant. Now, this data has now come in after the debt ceiling deal has been agreed. So this is the US consumer that gets a survey. So they should be feeling more optimistic now the debt ceiling deal has been extended. So I'm expecting this to be better. And 5-year inflation expectations, I am expecting them to stay about 3.1%. The lower they are, the better. If consumer expectations come in above 58, if this is lower than expected, 3, if we see inflation expectations for the 1 year dropping down below 4, and you see consumer sentiment falling, 57. So if you see 3.1 or lower, 54 or lower, 63 or lower, 57 or lower, then you'd expect the dollar to fall, you'd expect gold upside. Opposite, if you saw consumer sentiment really high and you saw current conditions high and you saw inflation expectations coming in, 3.2% or higher, 1 year coming in 4.2% or higher, then and then this coming in 58, 66, 63 for the other components, then I'd expect a gold downside and dollar upside and dollar yen upside. So that's what I'd expect. Quite a mixed, very eventful week potentially coming up, and there's a lot of potential opportunities. On Wednesday, we'll come back. I'll get ready for the Fed interest rate decision, and I'll look at the best commodity and currency pair that I will be looking at for trading that decision later on during the time. Okay, folks, just going to see if anyone's got any questions. It's a pretty busy time. Yeah, with your question, do check out support. I think it should be registered once, and then you should get an email reminder each time. And it's 12:30 GMT each time this webinar. Okay, folks. All right. Okay, very good. Take care. And oh yeah, here we go. Yes. Yeah, thanks, Saeed. The yen is definitely worth looking at. Now, what's going on with the yen is this. If you look at, let me show you yields here. Right. If you look at the yen here, if the green line is 10-year yields, right? And the candlestick chart is the yen. You see, as 10-year yields rise, the yen weakens. So what you see, falling yields, strengthening yen. Rising yields, weakening yen. Rising yields, weakening yen. That means when you look at the bond chart, you'll see that when you, you'll see that when you overlay dollar yen, see how close they track each other, right? So the Bank of Japan, let's just get rid of that now. The Bank of Japan at the moment, their bond yield is 0.426%, and they have been maintaining their ultra loose monetary policy. And despite, look at the other bond yields, you see how they're like, 3 here, for bunds is 2.7, CAD, it's 3.3 for Canada, 4.5 for New Zealand, Australia 3.9, UK bonds 4.2. But look, Japan's government bonds are still only yielding 0.428 because the Japanese bank, the Bank of Japan, is continually buying bonds and defending that level. They're trying to keep bonds stuck at that level. They're trying to keep interest rates artificially low. And if you look here, you can see Bank of Japan, look what their interest rates are. The interest rates are still negative, right? So a lot of people have been speculating, saying, well, surely they can't keep that up, the Bank of Japan, but they have been able to for some time. So the thing to look at for the yen, the one event is if the Bank of Japan, if they unwind that yield policy. So say they stop defending that 10-year bond yield policy, you'd expect the yen to massively strengthen. So you'd expect significant dollar yen downside. That would be the trade. So if the Bank of Japan stop buying bonds, you expect the yen to massively strengthen, and you expect 10-year yields to fall lower. So what you'd be buying is you'd be buying the yen against the dollar, so it'd be dollar yen downside with the potential trade. That's one to look at. With the Swiss franc side, last week we did have some better data out for Switzerland. There was a bit of pressure. I think it was around the start of the week. There was a bit of pressure off the, see, Swiss inflation came in year on year 2.2%, month on month 0.3%. So if you look at inflation for Switzerland, that's, that's fine. Look, 2.2%. It is at target. The core inflation 1.9, but it's dropping nicely. That does take a little bit of pressure off the Swiss franc. So at the moment, I'm expecting a little bit of sort of slight weakness for the Swiss franc. And you can see here, look, you see how the Swiss franc on an index level is dropping lower? that is nearly, isn't it? You know, head and shoulder, left shoulder, right shoulder. You know, looking for a measured move. If that's the head, you know, that's the neckline. So if there's a close on that level, you know, so that's Swiss franc weakness. So that could be CAD, Swiss franc upside would make sense, wouldn't it, at the moment? And if we've got strong labor data, maybe Aussie Swiss franc upside would make sense with that strong labor data. But Swiss franc seeing a little bit of weakness right now, and that's just trying to break out of that, you know, head and shoulders reversal pattern that you've got there on the Swissy. Okay. Okay, folks, been a pleasure as always. Do take care, and don't forget, Wednesday we will be back, and I will be getting us completely ready for the FOMC interest rate decision, and we'll be getting ready how to trade the Fed interest rate decision on Wednesday. So do come back for the workshop, and I'll be looking at a currency pair and a commodity that makes sense in light of the CPI print that we get tomorrow. Yeah, Saeed, please keep asking support. I am not responsible for uploading the webinar, but I do appreciate that the sooner it's available, the better, and I will do everything my end to keep prompting my admin support this end. But also, if you ask as well, then that's, you know, another person asking. Thank you very much, Saeed, for your kind words, and Fahad. That's great. I hope that works out and you get your answer to your question. And I look forward to being back on Wednesday. Thanks everyone now, and goodbye.